welcome to Fintech Insider Insights. I'm David Brear, Group CEO here at 11FS. In this episode, we're going to be taking a closer look at that tricky balance between managing regulation without compromising innovation. We'll discuss how to empower fintechs and the autonomy to disrupt and drive our industry forward, while also enforcing a fair, competitive and appropriate boundaries to make that happen. And to have this discussion with me, I'm always joined by some awesome guests, but we have a packed panel of great guests today. Firstly, we're delighted to welcome James Baston-Pitt, who is the VP of Growth over at Alloy. How are you doing?
Hey, really good, David. Thanks so much. You can even call me by my initials. That's what I'm pretty much known as, JBP.
There you go. It's a good way of doing it. Is that a Chelsea football in the background there? I've noticed the Jamiroquai thing in your office, but is that a Chelsea football as well? No?
You spotted it. There's some regulation books on there, a Chelsea ball and a Jamiroquai LP.
We've all got different hobbies, haven't we? Which is good. But from a football club with no money as Norwich City is to one with lots of money with Chelsea, we can probably talk about that later today as well. But for anybody in our listenership that doesn't know Alloy, tell us a little bit more about you guys and tell us a little bit more about your role as well.
Yeah, brilliant. Well, look, firstly, such a delight to be on the podcast. So my background myself, I came into the fintech world in 2015, and it's been a privilege to just see it change over the last nearly decade. I've held a variety of VP roles, most notably at Fido, which is a document and biometrics business, which worked with banks and fintechs that have seen that evolution over the last 7 years. But recently, I moved to Alloy at the beginning of the year to lead their UK expansion. And Alloy is a identity decisioning business, which helps top banks and fintechs take control of their fraud, credit and compliance risk to grow with the clearest picture of their customers. And we work with over 500 customers across the UK and the US to provide them with a holistic view of the customer across onboarding, transaction and behavioural data.
Very, very good. Very well placed to talk about what we're going to be talking about today as well, which is great. So lovely to have you on. It is also a Fintech Insider debut for Andy Thornley, who is the head of financial services at TechUK. How's it going, Andy?
I'm good, thanks. How are you, David?
Very good. Very busy week, I have to say. But I'm starting to get in that Christmassy mood. Like it was Christmas Carol-y stuff going on in the office today. So it's hard to be sad when you're hearing, great songs in that sense, isn't it? But for anybody who doesn't know TechUK, tell us a little bit more about the role that you guys play.
Perfect, thanks. So TechUK is the leading tech trade association in the UK with about 1,000 members representing everyone from all of the big tech firms down to SMEs. We're split across 23 different program areas. So that includes things like policy, developing technology. So we've got an AI program, metaverse program, quantum technologies program, and also market verticals, which is where I fit in. I head up financial services. In terms of what my members look like, they're incumbent financial institutions, new market entrants, law firms, and anyone who's got an interest in either shaping the technology policy landscape or learning more about what that technology landscape means for them and their business.
Awesome. And a big Fintech Insider return for Ed Pugh. He is the Development Director of Fintech and Digital Assets at Aon. Welcome back to the show, Ed. How's it going?
Very good. Great to be here. Great to be in person, David, as well.
I know. It's rare, isn't it? People in actual offices and stuff. It's a nice change, isn't it?
But, it's lovely.
For our newer listeners, tell us a little bit more about what does a development director do?
Well, I'm the front person for our fintech and digital asset practice. So my specialism's risk and insurance. The practice comprises talent, cybersecurity and M&A as well. So Aon, known as an insurance broker, it's more than that. It's a professional services company nowadays. And got loads of fintech clients. We love working with them, the small, the medium, the large. And it's great to serve the sector, great to grow with them.
Very cool. And risk with fintech and digital assets, there's quite a lot in that, isn't there, in terms of that space?
Been some big headlines today. Another round of big headlines. Maybe we can get onto that.
No doubt we will. In fact, let's get onto it, shall we? So thank you so much for joining everybody and for the panel. It's always great when our producers do an awesome job of getting the right people in. But maybe if we dive in. So first, we're going to take a little bit of a look at regulation. Now, it may not be the most exciting thing in the world, I know, but actually, fundamentally, rules are necessary in any marketplace. And arguably, I'd say, really, James, since you jumped in 2015 onwards, really, I'd say regulation has been the thing that has spurred the change in fintech globally. As the 2008 crisis really demonstrated the consequences of really ineffective rulings, it actually has a wide-reaching impact on not only the industry when it comes to financial services, but the economy as an absolute whole. So maybe if we jump into a little bit of detail on why regulation matters, who is held accountable when, and actually if we ever really can have too many rules. James, maybe if we start with you and Aloy's perspective. I mean, identity risk is quite a new one for people in terms of the impact that it can have on the industry, but also probably the speed in which identity risk is actually happening now. So why is it so important?
Definitely. Couldn't agree more. So like as you touched on, Alloy as a business is become very established in the US market for providing a risk decisioning layer that sits between the application and the tools that help to determine risk. Like, what is risk? Like, if you think of identity, there's this common theme of like verifying the person is who they say they are, or verifying the business is who they say they are. And your risk appetite is relative to how well you know that point. So how well do you know that person is who they say they are? From shaking that person's hand, through to capturing information and verifying it, through to assessing whether that information you captured is enough to be able to assess and make a decision on whether the services that you provide, which is ultimately the instrument, the financial service instrument that's being offered in return of that confidence. And ultimately, it's a bit of a lever. Like it's something which is, there's no one single point of time. It's something that rightly should evolve over time. So I was seeing like this tremendous kind of uptake around decisioning and orchestration, which is largely a case of mapping to this component of identity risk, which in the world of, as we move into the word regulation, and I love this kind of concept of a risk-based approach, is this point which is largely around trying to interpret your risk to be able to make an informed decision about how comfortable a business can be to be able to make it really super easy for a customer to be onboarded or provided with whatever service it may be.
Yeah. I mean, it's fascinating, isn't it? I mean, that point on, every business decision is essentially is a risk decision, really, and actually it's about the tolerance of the scale of risk that you're willing to take on, isn't it? We experience this in every walk of life. It's like, I could stick my fingers in the plugs, but actually I know the context of the outcome, therefore I won't do that. I could jump down the last 7 steps when I came down the stairs earlier on, but I don't do that because it's a risk and reward thing in terms of actually the benefits around it, right? And that point around orchestration, it's an interesting point, the different data sets and access to data sets that you can gain access to today in a digital world is much greater than it was before. Do you want to just sort of unpack that a little bit more? Because I think that orchestration is really important.
Definitely. So I think orchestration can come in a few folds, and fintech's like a fascinating one because in a way it's quite narrow in terms of the interaction they would have with customers. So like the great thing about like say 2015, if I look back to those times, is the main disruption sat around banking apps. Apps was this one single omni-channel, one channel to be able to bring on customers, which meant that the need for orchestration was in a way quite limited because you were kind of offering one entry point into the house. But what's naturally happened over time, certainly as banks have continued to evolve, is omni-channel's massive. So like there's this still great need to have high street interaction. There might also be a great need to offer other types of services like business banking to your consumers, or a loan, or provide the ability to operate in a new market, to be able to provide the ability to have a customer in France and you're based in the UK. I think the reason I say all that, because they're all the desires that fintech is looking to do, is you need to orchestrate a lot of things. There's so much complexity that evolves, or has evolved in kind of like the modern digital era, that now it's becoming really difficult to manage, and it's creating vulnerability ultimately. It's like you've got this huge desire we hear in the market of having a more holistic view of the customer, which I think is that desire of what has become quite a fragmented stack under the hood to be able to do all these things that consumers want and your business wants to do as you look to grow and establish yourself in new markets.
Yeah, I mean, there's so much in that. I mean, from the customer experience impact all the way down to the way in which the technology is implemented. Like, there's monolithic thinking leads to very monolithic outcomes, doesn't it? In that sense, but I mean, maybe sort of coming to you, Ed. We touched a little bit earlier on the big impact we saw in '08, and I mean, every financial crisis has a reaction, which is heavy regulation to try and stop what happened happening again. But I guess should good regulation be on the side of preventing problems or being reactive when they do happen? I come from an insurance background, so they always say the best way to solve a problem is to stop it happening in the first place, right? When it comes to floods or maybe not earthquakes, but solve the problem before it happens. I mean, is that the role, do you think, here that regulation plays, or is it a bit of a balance?
I think it's a balance. I mean, my wife's a GP, so she'll tell you that prevention is much better than cure. And, in a static market, that's a great principle regulation. But I think the challenge at the moment is the pace of change that we're seeing is so fast that it breaks the principles and regulators find themselves scrambling to catch up. I mean, if you take two different emerging technologies, digital assets or DLT and artificial intelligence, I mean, we've had the technology moving ahead of the regulation where there's no existing regulatory infrastructure that you can easily apply to the new way of doing things and the new business models that come out of it. That's one side. I mean, there are some core preventative principles, though, that I think just endure. I mean, if you take the interest of insurance as an example, I didn't know you had an insurance background. I knew there was something strange about you, actually. But now I know why. So, think about the insurance industry regulated by the FSA as it was since 2005, which is not that. I can remember when it wasn't regulated. And what do we have to do in 2005 onwards? We had to think about treating the customer fairly. Amazingly, it wasn't a regulatory requirement before then. And that endures. It applies equally to banks. It applies as it does to insurers or insurance brokers. Consumer duty legislation this year, 2 core principles: acting in good faith, avoiding causing foreseeable harm. I mean, those are fine preventative measures, right? Fine, simple, accessible principles that you can apply across the industry.
Yeah, and how often are they put in place because of a need to do so, because of behaviours that have shown people don't do those things if those things are not in place? It's obviously we've gone through the financial crisis, but then large scale mis-selling scandals like PPI and the regulation. Almost it's the rules and regulation. I mean, it's like the offside rule. They're tightening it up and changing it and tweaking it as people look to exploit it. Year in year, aren't they? So the regulation isn't particularly in the UK, it's not a rule book of do this and don't do this. It's much more interpretation, isn't it? Because exactly the ways in which they can be interpreted and therefore the principles applied to the conduct of an organisation is allowing both guidance but also restorative issues should they have gone wrong as well, right? So it's an interesting point you make around the constraints that things can bring, though, because actually, too much embracing it and therefore regulating out all of the opportunity actually can leave almost too much rigidity in the market, can't it?
Well, it favours the big guys, you see.
Absolutely.
This is the thing.
And we've seen this, like, what was it, 06, 07, the sort of starting to restrict on the liquidity requirements for capital for new banking applications, right?
Yep.
Actually changing those things and bringing about a competitive objective with the FCA, the C in the change from the S to the C. Actually, that focus brought about very different approach to regulation. But to your point around not just protecting the big incumbent organizations, but bringing about real competition, right?
Yeah, I think you need flexible regulation and regulators, they're on the public record being mindful of the impact that regulation has on smaller firms, because ultimately smaller firms play a really important part in driving innovation, right? I mean, they probably do the bulk of the heavy lifting there, right? And they find it harder for various practical reasons to comply with regulation. So there is a very, very careful balance to be struck.
Yeah.
Too much regulation will kill you. Not enough regulation will kill you. The truth's in the middle somewhere.
Sounds like a good sticker we should make at that point. But I mean, Andy, it'd be great to get your perspective on the tech side, particularly. I mean, obviously, when technology is changing so dramatically quickly, and talking about cryptocurrencies or digital assets or artificial intelligence, a plethora of different things. I mean, the regulator keeping up with those things in order to be able to regulate them is an interesting challenge in itself, isn't it?
It really is. And if you think about the pace at which technology moves, I think you can say that a rules-based approach doesn't necessarily work. I mean, to draw a parallel, when PSD2 was introduced, there was a €50 limit on contactless transactions. That assumed that inflation would never happen, and at some point it will need to be updated again. So writing hard rules for things that can change quite quickly doesn't necessarily work. And I mean, you referenced AI, and the regulators are currently engaged in a process of determining what rules or what approach they should have to regulating this technology. And the FCA itself is technology agnostic, it says, but brought forward with the PRA, with the Bank of England discussion paper looking at what their approach should be. And in the feedback statement that was published recently, we saw that actually there was a coalescence of both financial services institutions and tech providers, TechUK and other industry bodies. 25% of the responses actually were from trade associations, quite interestingly. But everyone coalesced around this view of, well, the FCA is principles-based and outcomes-focused, and that works from a technology point of view because you're able to adapt and flex for those approaches as technology develops and as the applications of those technologies develops too. I think also if you look at the coordination that needs to be in place for regulators, we need greater coordination, and that's not just within financial services, but across the regulatory piece. So I describe this a little bit like being regulatory Tetris, because you've got these nice market verticals. Imagine in Tetris, you had that block that was 4 long or 4 wide. And when things fit into that nice little gap that you've got in the market vertical, it slides in, everything's great, everything's happy. But when you've got a slot like that, and the only way that you can put it is lengthways, is horizontally, then you've got either bits which are missed or you get overhangs. And that's essentially the problem that regulators have got, where technologies cut across these areas. How do you have that joined up approach that regulation isn't conflicting between different sectors? And also the rules that are put in place don't have overspill to other areas. We saw this recently with the operational resilience for critical third parties work, where some of the cloud providers in this space said, sure, you can regulate to bring technology firms into the scope of these regulations, but where you've got co-residency and other organizations based on that same physical infrastructure, might be a health provider or something like that, you've got overspill into those areas. So inadvertently, you're regulating in areas that are outside of financial services. So I think there's a real challenge, but keeping things principle-based and outcome-focused means that you can measure things a lot more easily, and they can change as technology and the application of that continues.
Yeah, it's fascinating, isn't it? Given the movement in technology is so quick, the sort of adoption and evolution of those things is happening so quickly, then actually it's almost an impossible task for anybody to keep on top of these things. Never mind the regulator in terms of the sheer breadth of the change and the impact. And this isn't just for a adoption of big businesses perspective, but we're talking about pretty innovative fraudsters kind of being using various different types of technologies to really go above and beyond even the wildest dreams of a regulator 5 years ago. So it is an amazingly shifting landscape, and that is a very different problem to face into, isn't it? Actually, are regulators set up for this? I know we'll get feedback because we know we've got lots of them listening to this show, but I mean, the whole Innovate project in the UK initially, I've always thought about it like it was a cultural transformation thing as much as it was anything. And actually the changes that we really saw within, the establishment of the PRA and the changes in the FCA, the great work that people like Chris Woolard did and various different, actually it was changing how people thought rather than just the fact that actually sandboxes exist in these things. But do you think the regulators globally are actually equipped to change at the pace that the world is really changing? Who wants to take that hand grenade?
I'll start if that's okay. The relationship that we've got with the FCA is great. So hello to everyone over in Stratford. But with that, I think there's 2 things. One is skills. And whilst there are great people in the FCA, let's be honest, if someone like DeepMind or, kind of a large hyperscaler wants the best talent, they can just go out and throw money at the problem. When you're talking about public funds, that's less of an option. So how we make the regulators attractive places to come and work for the best talent, I think is an interesting question there. And then in addition to that, I think the changing culture within the financial services regulators is actually quite an interesting thing, as they grapple with the same issues that financial services firms themselves have got. So the amount of information returns that go to the regulators increases year on year, and they themselves are using artificial intelligence and cloud services to be able to deal with this and to be able to provide the service that they need to. And it's exactly the same sort of issue that financial services institutions have got. So whilst one is a regulator and one is a firm, I think we've got this actually, kind of shared experience that, kind of as the world keeps turning, as we get ever more data, as, kind of the requirements keep increasing, then we've got this opportunity. And I think the regulators are going through that at the same time as financial services firms. And we see that through, kind of the more relaxed approach to public cloud, for example, compared to what we had about 5 years ago.
Yeah. I guess to that sort of question, a slightly different angle then, and maybe sort of bringing other people in. I mean, is there ever too much regulation in an industry? Have you ever sort of seen an instance where the regulation is inhibiting innovation in the space?
Not sure. I mean, too much is one angle. Customers of ours have complained sometimes about contradictory regulation, which is, I think, equally harmful. And people want to know what the rules are. Right. And if you look at the digital asset sector, what have they been crying out for? The reputable players have been wanting to, well, just give us some rules and we'll comply with them. And there's been back and forth. If you look at to the earlier point about the regulators globally, there's been a hugely varied responsive reaction to regulating that particular part of emerging financial technologies. Offshore locations have got, in some instances, quite stable, well-established regulatory regimes. The EU's got MiCA, it's enforced now. We're got a little bit in place and we're on watch and see. And the Americans have fallen out themselves, badly, So there's a huge variation in quality of regulation out there, I think. And certainly in some sectors, certainly emerging sectors, of course, the regulatory regime is incomplete. So it's not a case of too much. It's a case of too little, I think, at the moment in that particular part of the regulatory environment.
It's funny, isn't it? I'm sure there's a kind of a far smarter person than me that's come up with some sort of particular wisdom or rule of thumb on this one, but it's none is definitely a problem and too much is definitely a problem, right? But there's got to be a happy medium in the middle there. Maybe answering my own question on that one, we've built banks in 12 banks in the last 7 years. We've done it in various different regulatory regimes around the world. Definitely a lot easier in some places than it is others, and actually the people who were looking to work with organizations to make great things happen, to better the customer result, marked difference from those who were looking to stop people getting over the line. It's very, very different approach. And I think that sort of points to kind of some of the things that you were talking about, Andy. Actually, I mean, if you can point over the last decade of things that people like the PRA or the FCA have done, I mean, even back to, examples of holding out North's hands to implement into the cloud, or, steps that were kind of taken to move not just one organization forward, but their learning and the industry forward. Kind of that's what you want to see, isn't it? You want to see that in the same way as what you want to see in corporates or startups is a point of experimentation and moving things forwards. Can you keep learning? Can you stay humble enough to know that the world is changing? And probably that's the best thing that you can see. But we've discussed at the first part of the show the importance of good regulation. And I think we've come to a bit of an agreement around maybe not exactly where that line is in terms of it being super effective or ineffective. But we know it's important, regulation, right, in terms of all of the things that we're doing. But now we're going to try and apply this to fintech and look at how this can actually support and even encourage innovation and that progression that we're looking for. It sounds kind of crazy, doesn't it, in terms of putting it in that context. But maybe first and foremost, maybe if we look at if finance isn't broken, why are fintechs trying to fix it? I know that sounds like, I often say it's like fintech is just opportunity still left on the table by big organizations, right? Would that sort of echo with what you see?
I think it would do. I mean, I think it's too strong to say finance is broken, but it's clearly the customer experience provided by the established incumbents has for a long period of time not been good enough.
Yeah.
They've got a tough gig, of course, because they have legacy systems. Change is harder from a practical perspective as well as it is from a cultural perspective. So broken's too strong, but it's certainly not been good enough.
Well, it's a funny one, isn't it? I mean, it's like, again, the thing, you mentioned earlier on, the sort of treating customers fairly narrative. And it's like a bank having a digital strategy. You don't need a digital strategy if you're digital, right? You don't need to be told to treat customers fairly if you're treating customers fairly, right? It's so it's an interesting sort of context around. I mean, Google used to have the do no evil, didn't they? Because they were trying to, or the move fast and break things with Facebook. Actually, those things are put in place to sort of counterbalance the narrative of the industry to a certain degree. So as you say, broken might be too strong in terms of the broadness of it, but definitely it's not working for everybody in the way in which financial services could serve people, right?
Yes, and I think it's been encouraging to see at a macro level increased competition. And that comes from, if you take an example, a small example, clearing banks. I mean, we had no clearing banks for hundreds of years. Then one formed in 2017 and then another one formed last year.
It's like the 4-minute mile, right? One person does it and then everybody's like, oh, Nick did a thing, we can do that thing, right?
Yeah.
It's amazing that change, almost not just the change in expectations from a customer's perspective, but actually the industry of actually how hard things are. But James, I guess a big part of that in terms of how hard things are, though, is actually having B2B players in the market to be able to do these things with, right? Because actually, telling Tom and Anne and these guys at the beginning building a challenger bank was, it's easy now. It's just a card processor. Those things didn't exist. So are we seeing such an advancement in the B2B space that actually allows the building blocks of innovation to really happen now?
It's definitely where the innovation sits, it seems right now. There's a turning of the tide right now. There's a real expectation, I think. It's this bit about being outdated. I think that point you touched on, I don't think it's broken. Everything's just a bit outdated, and it gets outdated really quickly. But I think that some bits get outdated really quickly. Even I think some fintech elements to it is already outdated, and some bit is just really old and just there hasn't been the innovation yet. So I think B2B is the standout. That hasn't actually changed too much in the last, hasn't changed enough to really see what kind of the next B2 of it is. If I think about I travel to London a couple of days a week, and if you just look at the regeneration of buildings, there's nothing really broken about them. But I just find it amazing over the last eight years coming down, how many have been crushed to the ground and new ones that have been flying up. There's just a better way to do things. And you then think about how often they kit them out as well. Fintechs do redo their offices more than every year. And I think that's the same expectation when it comes to when it comes to actually what they're offering to the market as well.
Do you know, that's an interesting context. I often sort of joke with clients when we're starting at projects. I'm like, is this a new build or is it a renovation? Because having lived in a 300-year-old cottage for a while, renovations get a bit messy and a bit expensive. You know what I mean? So it's, but it is an interesting context. And I mean, arguably, we've talked a little bit about competition. We've talked about the regulatory space. I mean, I always kind of point people towards the innovator's dilemma. I mean, it's that classic sort of Clayton Christensen's, is it easier to start from scratch than it is to evolve an incumbent in that sense, isn't it? And the argument is probably it's somewhere between the two. And I mean, really, that's why we're seeing people like Chase or people like NatWest build completely new things, because essentially it's easier to overcome them by making a leap than it is to evolve in that way. But I think to your point, though, I think it's almost a different. I always. I'm going to do a terrible accent here, but I always kind of make the joke that, the joke is if you pull over, I live in Norwich, so if you pull over in Norfolk and ask somebody where Haysborough is and you're in Swaffham, they'll tell you not to start from here. And I didn't do the accent. Imagine me doing it in a Norfolk accent, okay? But, and that really is what most people are kind of finding is that almost the raising of the bar when it comes to the approach to making these happens is making people start from a completely different place. And that's not just, neobanks. It's cloud, no fintech with any, grain of smarts these days goes like, where's my 4 data centers going to be, and what do I, because it's just a problem that's actually been solved, isn't it? So, but I guess to that point, what problems are fintechs really trying to solve in this market, Andy?
I think starting with the problem is a really, really good place. Kind of back to your Swatham comment. There's a lot of people who start with technology. So not fintechs, but I spoke to a large investment bank recently who wanted to meet a bunch of tech firms. So we helped organize a day for them. And the brief was, we want something to do with AI. And I'm like, okay, but what are you trying to solve? Because it might not even be AI which solves that for you. It might be a change in process, for example, whisper it, but the answer isn't always technology. I think this comes back to, kind of progress and the role that progress plays. It's why we've got light bulbs and not candles now. And the more that technology and data enables new things to happen, there's always going to be people who innovate on that and take the advantage of being more nimble, more agile than incumbents. And as Ed was saying, kind of incumbents are, kind of hamstrung quite often by legacy too. A lot of the core banking systems, for example, are based on mainframe, where challenger banks and the like might use more cloud services, which, new technologies like AI and ML can be better implemented. So I think it's worthwhile taking that step back and having a look at, okay, well, what's the landscape? Where's the opportunities here? What, kind of problems can we solve which we couldn't solve yesterday? Things like open finance and the stuff that CFIT is looking at with the role that technology and data can play in helping SME finance, for example. It's really super important, underserved segment of the market. And all of a sudden, kind of through data, through technology, solutions could be available that has a real tangible impact, both for those SMEs, but also for UK PLC. And we all prosper from that sort of stuff. That transformation point, though, is really, really difficult because it's costly. There's risk inherent in there. Kind of there's 3 of us on here who've had an insurance background, myself, Ed, and yourself there. So, kind of we look at things quite often from, it's quite risky, it's quite expensive, kind of do we just continue doing what we're doing? And I think for incumbents, the risk is if they don't embrace the transformation journey, then they get left behind. That provides an even greater opportunity for fintech firms to be able to step into the space. We started this discussion about the role of regulation, and in the autumn statement recently, we saw in the documentation that government are going to bring forward legislation to allow new payment architecture using open banking rails. That's the type of role that regulation can play in creating new markets and new spaces, essentially, for products and services to be delivered by fintech firms, which might be a little bit harder for incumbents. So I think really that's the problem that fintechs are looking to solve. To answer your question in a long way, it's how we can use new technologies and kind of new sources of data to be able to provide value to our customers, where potentially kind of you can outfox some of the more kind of traditional incumbent players that are hamstrung by legacy.
It's funny, isn't it? The sort of moat around financial services used to be regulatory, and now actually it's like the old vampires can't come in without you inviting them in, right? The regulator has taken more of a inviting them into the house approach because of, to your point, the impact that it will have on the incumbents in that sense. But it's a funny one because that narrative almost kind of points to fintechs being like the new puppy you buy to get some life out of that old dog that you've got for a little while. But it's not quite like that, is it? It is. Market tension brings about better outcomes for customers, doesn't it? And actually, that outcome isn't just a cheaper credit card or a whatever. It's like fundamentally, it's like people are like vying for your custom. And that's a really important thing, right? Because that stops financial services becoming commoditized and a utility. It actually makes it a point of value add across the industry, which I'm really excited that we're seeing those propositions really come to the market.
Ed mentioned it earlier about the interpretation of the regulation is really hard, but I think that's where the innovation sits. And with the interpretation of regulation, especially when it's new regulation, I think the benefit fintechs have is they don't have that regulatory debt. So to have regulation, you create your standards, you create your policies internally. And what I've seen is actually that policy debt is the hardest thing to drive innovation or doing things new. It's not necessarily the regulation itself, it's the regulation updating itself and you not being able to move quick enough. And that's where fintechs have this great opportunity to be able to be innovated there.
Kind of capturing the opportunity, yeah. I mean, it is an amazing sort of dynamic that plays out though, because almost, the argument we're trying to make here is like, I mean, it's a bit of a chicken and egg, isn't it? I mean, is innovation more important or is regulation more important? Do we need the framework in order to understand how to play the game, or actually is jumping in and learning these things? And actually that is often perspective, isn't it? Actually for a big incumbent organization, tell me the game and I want to be able to play it effectively. For a startup in the market, it's like I'm going to figure this stuff out and I'll tell you what is possible, and almost like the perspective on whether regulation or innovation is more important is probably down to, I mean, we talked about risk. It's like how much you've got to risk, right? Actually, do I jump down those last 6 steps like I talked about earlier on? Not at 40 years old, you know what I mean? Like actually, maybe when I was 15, sure. But, so the risk is not the same, is it? So, but I guess maybe to kind of ask you guys, I mean, what do you see? Do you see the should companies be prioritizing the regulation side of things or the innovation side of things? Do you see one of these more important than the other, or is it two sides of the same coin? Ed, maybe starting with you.
Well, I mean, if you fall foul of the regulator, there's a huge reputational loss, right? And I've worked for big companies, I've worked for startups. Big companies have a reputation to protect that's built up over many years and can be lost very quickly, without naming any names. So I think instinctively larger financial institutions are more likely to take a conservative approach because of the reputational dynamics of it. I would say the perception's probably reversed for the smaller companies. They're risk takers by nature. The founders are more likely to be risk takers, I think, based on those that I've met. So their calculation around risk and reward comes from a different perception.
Yeah, it's less to lose, but equally, if you do lose that, I mean, ultimately we're talking about trust at that point, aren't we? If you lose the trust pretty early, it's going to be very difficult to build and establish a business. But I mean, I think we could do another whole hour on trust, couldn't we? Because that's as a metaphor for what that means within the regulation, it can be really, really impactful. But James, what do you reckon? Should people be sort of prioritizing the regulatory side of things or the innovation side of things in today's market?
So I think it depends. I kind of have this kind of mindset of this kind of like rip at the rule book changes, things that happen that regulation is just not ready yet. So crypto, buy now, pay later, AI, these sort of things are kind of like just come in, and regulation and innovation kind of needs to run in parallel. You need to be safe to deliver these kind of like seismic changes that have never appeared 15 years ago. I think then there's a difference of like new businesses offering similar but doing better, where like your innovation falls back to a bit earlier is your interpretation of new regulation there. So like that's what I think regulation is important, because new businesses, you don't want them to become ultimately cowboys or do things wrong. It's important to protect whatever it may be. So their ability to innovate on top of that is a great thing for whatever it is that's being changed.
Yeah, it is an interesting one. Andy, what do you think? Is it a focus on innovation, focus on regulation? Is it a pendulum rather than it being a binary decision?
Yeah, I think it is a pendulum, and completely endorse what Ed was talking about there around kind of different profiles compared to kind of different sized organizations. I think when it comes to regulation, when it comes to the risk there as well, I think there's ways that regulators can look at this as well and to say, well, actually, how can we promote pro-innovation agendas whilst retaining, kind of customer protection in there? So with going back to that AI discussion paper the FCA issued, they were talking about SMCR. Now, and should there be someone under SMCR, senior managers and certification regime, who is responsible for AI? So our response after speaking to members was like, well, actually, kind of, like I said, we come from the insurance industry. When you have a lot of risk falling on one point, one individual, all of a sudden, like a canary in the coal mine, kind of risk becomes more, if you're trying to get an insurance policy against something like that, it's quite expensive because it's a single point of failure. And I spoke to an asset management firm who were delivering an AI-based solution. And the compliance team said, do you know what, we're comfortable here that this, abides by the relevant code of business sourcebooks. And the CTO who's in charge said, actually, this falls on my head rather than yours I'm not comfortable with that. So I want to be more conservative in the approach. And I think the risk that we have sometimes by introducing things like SMCR specifically for, utilizing technologies and the like means that people inherently look at, kind of their own risk profile and say, well, actually, this falls on me and I'm not comfortable with that. And we get less innovation as an approach. So I think to answer the question in a slightly different way, it is a mix of both, but we can also do better with that, with the way that we regulate. And we can still ensure those consumer protections in there. That's absolutely vital, especially with new technologies like AI, where there is a suspicion from some members of the public about how data is used and the like. We need to give absolute confidence in that, but that isn't necessarily, at the cost of innovation and delivering new innovations.
Yeah, I think to chuck my 2p on this one before we're rapidly running out of time, so we're going to have to close out. But I mean, I've never found the regulator to be the problem. Like around the world, I've never found a regulator that didn't want to serve customers more effectively. Often, to your point, it's the incentives of the people within organizations it's way riskier to do nothing than it is to do something. But actually, that makes sense if you're in a role where you're trying to avoid risk. It doesn't make sense if you're in a role where you're trying to change the organization, right? So that really becomes a challenge. But I think it comes back to, and we've had some, the great and the good on this podcast talking about this subject matter. Goes back to Sir Mark Walport, who was advising the UK government on this stuff. I mean, if the medical industry can test new drugs and, push regulation and move those things forward without killing everybody, then financial services should be able to find a way to innovate without losing everybody's money in that way as well. So I kind of feel that that's probably a good place to leave it. Innovation is probably not innovation in capital letters and shouting at everybody about being risky with money or being risky with technology or doing things that people shouldn't. It's about finding better ways of doing things and being restless enough to continually to keep pushing those boundaries and keep pushing things forwards. But on that note, this does wrap up today's discussion. So thank you so much for joining me. Where can people learn a little bit more about you guys and all the good work that you're up to? James, starting with you.
Yeah, so you find me at alloy.com. Make sure you check out the website. Like I say, just launched into the UK. And for me, don't have a Twitter handle, but find me on LinkedIn or drop me an email. James@alloy.com.
Very, very cool. Andy, where can people learn a little bit more?
If you want to come along to shameless plug, over 400 events a year that we do, it's techuk.org, and I'm on LinkedIn, Mr-Andy-Thornley.
Dang, 400 events. There's not actually enough days in the year to do that amount of events, but that's impressive, I have to say. It's multi-geos, lovely. And Ed, where can people learn a little bit more?
Find me on LinkedIn, linkedin.com/Ed Pugh. I got in quickly.
Yeah, you got that handle straight away. That's good. Yeah, for me, it's always LinkedIn these days. You can find me lurking over there. Thank you so much for listening, everybody. If you like what you heard, then follow the podcast and don't forget to leave us a review. Helps us make it better and helps other people find the show as well. As always, if you want to join the conversation, find us on all social media channels. Just search for 11FS or Fintech Insider or email us on podcasts@11fs.com. Thank you so much for listening. Goodbye.